Hello and good morning, everyone. Thank you for taking the time to join us this morning. I'm Santiago Lizalde, Business Development Officer at ATRAM. Today, we will be focusing on how to follow the smart money by diving into ATRAM's Smart Index strategy. If you have any questions, you may send them as early as now by clicking on the button at the bottom of your screens. Before we begin, I'd like to let you know that this session will be recorded and that copies will be disseminated within the day, as well as posted on all our social media platforms. If you have any friends who you think would like to attend this webinar but are unable to do so, feel free to share the YouTube replay of the session. To do that, you may visit our YouTube channel, ATRAM Studios. We'd also like to invite you to join ATRAM's official Viber community group, #ATRAMPH community, to stay updated on the latest announcements, advisories, and reminders. Go ahead and scan the QR code or visit the link on your screen. Please also feel free to send your questions all throughout the webinar, as we have a special surprise for all of you. Each question you send will be a raffle entry for a chance to win ATRAM merchandise. Winners will be announced at the end of the webinar, so please make sure to hang around until then. With that, let us begin. We're joined today by one of ATRAM's multi-asset portfolio managers, Ivan Ante. Ivan has been in the asset management industry for over 8 years and currently manages ATRAM's public multi-asset funds and several of the firm's wealth mandates. Prior to this, he has had extensive experience in Philippine equity markets as a portfolio manager, analyst, and dealer. He is a CFA charter holder, a Life Management Institute associate, and BAP Treasury certification recipient. Before joining ATRAM, he worked as a money market liquidity manager at a local insurance company. Good morning, Ivan. I hope all is well.
Hello, Sandy. Thank you for that. Good morning. I'm really glad to be here today because I will share two things. First, regarding a brief market outlook on what themes we're looking at this year. And second is how we can take advantage of this view and invest for the long term. I'm going to explain what the Smart Index strategy is and how it works. So let's start with the market outlook. There are three key factors that we are looking at. First is the recovery and reopening theme. Last year, we were locked down in different magnitudes, but as we move towards effective testing and mass vaccination, we expect the economy to fully reopen and for people to start going back to normal again. What does this mean? What it means is that from our 9.3% drop in GDP last year, we expect the economy this year to bounce 9%. From the drop of 40% in corporate earnings, we forecast 45% this year and 11% in 2022. This combination of low base last year and pent-up demand from households and consumers will drive this recovery. This is positive for cyclical companies and those sectors that got hit badly last year. Second, the BSP guided that it will keep supporting the recovery by anchoring interest rates to its record low. This means corporations and consumers are incentivized to borrow and spend. And remember, spending is another person's income. And that person's higher income will lead to more spending, and thus the virtuous cycle of more spending and more growth will continue. As the private sector reorganizes, government spending is crucial to take up that slack. We think that government spending and stimulus is needed because it gives the private sector more confidence about the long-term trajectory of the Philippine economy. In the near term, we expect lower interest rates, more government spending, and lower tax rates for corporations, which can lead to more corporate and household spending. This is also positive for risk assets and relatively negative for long-term government bonds. Lastly, there are wildcards that can significantly change our outlook. First is the timing and execution of the vaccination program. The faster we get to herd immunity levels, the more positive it is for the economy and corporations. However, on the flip side, if we continue to experience lockdowns and slow vaccine rollout, then a lot of businesses will have a hard time operating. This will have wide-ranging consequences of business closures, lost jobs, bankruptcies, and lower growth. The second wild card is inflation. We've seen a 4.2% print of the CPI last January due to higher food and transportation prices. If inflation continues to be above the BSP's target band of 2 to 4%, that can have negative initial consequences for both equities and fixed income markets, like what happened back in 2018. Lastly is the 2022 Philippine elections. We all know that elections boost economic growth as spending accelerates prior to the elections as politicians start campaigning. This just means that more money in the hands of consumers and not inside the bank accounts. That's positive for the economy. So just to summarize that brief market outlook, 2021 will be the year of recovery and reopening due to pent-up demand and low base. This will be supported by low interest rates, higher government support through higher spending, lower corporate taxes, and vaccination programs. However, there are potential risks like higher expected inflation and slow vaccine rollout, leading to more COVID cases and lockdowns. Therefore, we prefer equities versus fixed income in this scenario as it gives us more potential return, but obviously also higher volatility. So, okay, that's the view. How do you take advantage of this? This is where the Philippine Smart Index Equity Fund comes in. Now, I know that's quite a mouthful, but let me break it down for you. This fund invests in the Philippine stock market, primarily in the components of the 30-member PSEI. Okay, that's good, that's clear. But what is Smart Index? There are three characteristics of a Smart Index fund. First is that it is a combination of passive and active strategies. Let me provide some context first. Passive strategies are those funds investing by copying exactly the components and weights of an index. There is no active selection involved. So now the question is, who decides the weights of those index names? Well, for the PSEI, it is the PSE, and the main factors are size, float, and liquidity. So the biggest company that has a lot of available stocks for the public and reaches minimum trading volume will have the biggest weight in the index, in this case, SM. On the other hand, active strategies focuses on stock and sector selection that is based on fundamental, technical, sentiment, or quantitative methods. This means that it can vary very far from the index. So for the Smart Index, we want to combine the best of both worlds. We believe that it is hard to beat the market, but it can be beaten. So for this fund, we use the PSEI as a starting point, and we select which one of those names we prefer based on our proprietary rules-based methodology. We shall start first with the question, then, of what drives share prices. To give you a brief overview, let me discuss the factors, right? There are many factors and school of thought, but what is common is the belief that the current price does not reflect the price where it should trade. In our methodology, we are using 4-factor families. First is earnings and sentiment. We believe that the market is not efficient in incorporating new earnings and analyst information, and there exists a window of opportunity to take advantage of that. Second is quality. We believe that it is highly desirable to own high-quality businesses with strong business models. And over the long term, there is more reward for companies that have more certainty in their cash flows. Third is valuation. In the long term, over a full business cycle, companies that are relatively cheaper versus its competitors and the market will outperform. Lastly, momentum theory states that stocks that did well in one long-term period, say 1 year, will do well in the next year. While in the short term, say 1 month, stocks tend to overreact, leading to short-term reversion and correction. Now, most active managers, they use 1 or 2 factors. But what we've found is by testing and combining these factors together systematically using quant approach, we get a more consistent signal while reducing the noise. The actual nitty-gritty of the methodology is a bit more technical, but the spirit is the same. So now I've discussed what is Smart Index and the factor family that we use. So the next question now is, do you have proof that it works? This is the performance of the fund last year, and it did exceptionally well in the face of extreme volatility. We outperformed the benchmark by 258 basis points, net of all fees and costs. Now you might say that might be short-term period and we are long-term investors. And you're right. This is the 4-year performance since inception of the current methodology. We are up 6.44% over that period, and we outperformed the benchmark by 207 basis points. Now on the right-hand table, we can see a more blow-by-blow comparison between the fund and its benchmark, the PSEI. Yes, we outperformed the market, that's good. But what's equally important for us is that we did it with less risk. because it can be the case that you outperform your benchmark, but you double also your risk. But not in our case. We outperform while reducing our risks to our clients. So, okay, just curious, right? Because there are a lot of passive and active funds in the market out there. How did we fare against those? Let's compare first with passive funds in both 1 year, 2020, and 4 year time period since our inception. We are in the first quartile in both. That means we are top performers in both short-term and long-term environments and in any economic environment. Now, how about if we include active funds? So we include passive and active funds in this universe, and we are still in the first quartile in both. That means you are a top performer whether you are active or passive funds. And for your interest, there are 61 equity funds out there. So we are outperforming most of those funds out there using this framework. So the proof is in the pudding. We not only beat our benchmark, we beat it by a large margin with reduced risk. Importantly, we did not only beat the benchmark last year, but also since inception. Finally, even against a whole field of active and passive strategies, we are still top performers at a lower risk and cost. So what else can we do, right? That's all it is. This is all the fund management is all about. So that's good. Well and good. Smart index. It's outperforming with less risk. But you might be wondering, what are the benefits of this fund, right? So you can see, as I mentioned earlier, and I will summarize now, you get outperformance versus the benchmark and even against peers. You get market returns because we're a combination of passive index, but reduced risk. And you can participate in the Philippine recovery as we go forward and resume our long-term growth trajectory. So again, if you are now watching, you might be wondering, is this the right fund for me? And yes, you are right. This is the right fund for everyone actually. And obviously also for newer to investing and wants to participate in the stock market. They want to employ their savings and away from almost zero interest rates in your banks, right? If you look at your TD rates, that's almost zero in 1 year. So you might be very interested in looking for higher yield and higher returns. But obviously you have to take care and also look at your appetite for risk if it's good for you. And if you can, you have the ability to take that. This is also for intermediate investors that wants to combine active and passive benefits. You want to diversify your methods. It can be a complement to a stock picker. For example, you pick your stocks in the stock market on your own. But if you want a more systematic strategy that has sort of a PSEI-like return and you want to combine those kinds of strategy, then this is the perfect fit for you. At the same time, you diversify away from just fundamentals by using a systematic methodology, a rules-based methodology that stands the test of time. Lastly, this is also for asset allocators, those big guys, because if they want to get large cap and market beta exposure that gives a higher return versus fixed income, obviously higher volatility also, then this is the perfect fund for you. It gives you market returns and outperformance, and again, reduced risk. So in summary, this really is a fund for everyone. And we're happy to announce that this fund will not be only available in Seedbox, but also soon be available in GCash. So that's it for me. That's quite fast. We are here for more questions later. So if you have questions, please feel free to give us your questions. Thank you for listening, and I hope you invest in the first fund of its kind in the Philippines. Thank you.
All right, thanks for that, Ivan. Yeah, we can open up the floor to some questions. We've already received a few, but let's keep them coming, guys. Again, you'll be able to win, a question actually is a chance for a raffle item, right? So let's keep them coming. First, you mentioned right at the beginning of the portion, you had an outlook. So there's a question here from an audience member, right, regarding the 2022 elections. right? Will that produce a more volatile market, or what are your ideas on that?
In general, elections doesn't, or at least Philippine elections doesn't lead to more volatile market because if you look at the policies of the government, we do not have like in the US, there's a Republican or Democrat. They have their pet projects or pet policies, and it will change policies that much. In the Philippines, there is none of that. The common thing about the Philippine politicians that are likely going to be running for the elections is that they will spend a lot of money because we are in a rut. The Philippine economy was down, like what I mentioned, 9.3%, and we need the help we can get. Obviously, that also works for their benefit because it gives them a lot more face time with the voters. So, in summary, it doesn't lead to more volatility, but it leads to more economic growth. That would mean also that is positive for equities in general.
Right, that's obviously excellent to hear. No? And then, I mean, continuing the story, right? Especially the recovery story that we hope to be seeing and that the fund is invested in. Is there any specific industry that the fund is overweighting, or what do you think? Yeah.
Sorry, I did not catch that last question. Can you?
Yeah. So given the recovery story, right, that the product is investing in, and that we hope to happen actually, is there any specific industry that the fund is overweighting?
So that's a good question. Based on our methodology, what we find out is that obviously we have new information all the time, right? And that's what this methodology is all about. Getting all those kinds of information, combining them, and giving us a signal on whether this particular basket of stocks will outperform or underperform relative to each other. So to answer your question, what we are looking at, the current scoring is leading us to overweight more in industrials sectors. It's leading us to invest more in the banking sector, and also a bit of improvement in holding companies. So before, relative to last year, when back obviously in March 2020, we were underweight all those industries already. So that's why we outperformed. I think the methodology captured that there's a risk in the system, and that enabled us to really outperform. And this year, because it's a recovery story, there's new information, there's a lot more optimism, there's a lot more certainty in cash flows for businesses versus last year at least, then those that are badly hit last year will tend to recover faster in terms of growth rate versus, for example, consumer staples or utilities, those that outperformed last year.
Okay, great. Thanks for that. And this is a little bit more skewed towards, not just Philippine equities, but more of your portfolio kind of as an investor. How does the local stock market seem to look against global stock markets moving forward? Should we allocate more on global equities rather than local equities?
That's a good question. My immediate answer to that, because I'm a multi-asset portfolio manager, it is really good to be diversified across, like what my favorite is, you don't want to be stuck in one asset class or even in one currency. So the answer there is it's definitely good to diversify to global equities, specifically because in Philippine equities, you have our economy and our companies are more cyclically oriented versus other economies. Like, for example, the US was a lot more tech and healthcare in their companies. China and Korea and Taiwan also have a lot of tech exposure. So it's very good to have different exposure in both countries and sectors and currencies, right? But in our multi-asset portfolios right now, we are both overweight Philippine equities and global equities. So it's not whether it's going to outperform, but we think it's going to outperform both relative to fixed income this year. Um, so so I think it bodes well if you invest in both. And the most important thing is you diversify. So for example, if there is a idiosyncratic risk, like it's a Philippine specific risk that we're looking at, if you're invested in global equities and this is the view, you still take advantage of that view. So you express the same, you express it in different ways, but while diversifying your exposure and thus giving you more robust risk return for your portfolio.
Excellent. Yeah, that's the great answer from a multi-asset portfolio manager. And then, okay, so shifting towards the product itself, what makes it smart? I mean, it's in the name, right?
Yeah.
It's obviously you're going to put in the name because that's right. That's the goal, right? So what makes it smart, and what is the difference between getting or investing in the ATRAM fund versus other index funds? Because obviously there's a lot in the market, right?
Okay.
It's not just
yeah,
one,
definitely.
So differentiate it as much.
Okay. That's a good question. So smart, obviously, if you know the opposite of smart, it's kind of, I don't want to mention that word, but basically, if you are investing in an index fund, like what I mentioned earlier, it just copies without thinking, right? So, but what we find out is that there are ways to outperform the market if you do it properly and consistently. And that's what we have in this fund. That's why it's smart. We've found ways on how to consistently uh, get signals that lets us know where to allocate the money or which stock is preferable than, for example, is it preferable to own SM or SMPH or ALI or AC? So you have to have a relative game, right? So it's smart in that way that it gives you a signal. So you have a combination of passive and active strategy. So I guess I think I mentioned this earlier, but I think it's good to discuss this again. People invest in index funds because based from their own experiences and some academic literature, that it is very hard to beat the market. A lot of the funds, active funds, historically, um, have not been able to beat the market. And there are many factors why. Because first, there are fees, there are management fees, there are transaction fees, and also obviously there are other market structure events that leads to that kind of phenomenon. But it doesn't mean that it can't be beaten, right? And soon, it's like a meritocracy. Only the best fund will survive. Um, if you invest in an index fund, your funds will be, or your performance will be average because that's what an index fund is. It's an average fund because it doesn't do anything. You will get also the same risk, the full risk of a index fund. You get the same return and the same risk. So in this fund, that's why it's smart. It gives you higher return than the index fund, and then it also gives you less risk. So that's a very desirable combination. It's very hard to get that kind of combination in any fund. And then, and then one part of that answer is really using those four-factor families that I mentioned earlier: earnings and sentiment, quality, momentum, and valuation. Obviously, there are many metrics for that for those factors, and we use at most 10 to 15 factors and metrics to see and to combine those in a way that gives us the best signal possible. Because like other funds, sometimes you're a value fund, sometimes you're a growth fund, sometimes you're a momentum fund. But what that makes is that in some environment, market environment, one does well and the other doesn't. It's a it's a zero-sum game, right? One wins, one loses. So what we found out is by combining in our proprietary method those four factors that it gives us consistent returns in all economic environment. And that's what we showed you when we showed you the returns in 1 year and 4 years, right? And also against peers. And then I guess the last question is, what's the difference between the active funds of ATRAM and passive funds of
No,
ATRAM, right?
actually, the last question, or the other part of the question was the difference between our index fund, which is this one, compared to the other index funds in the market.
Oh, okay. So I think I answered that already. The main difference is that our fund outperforms and the other funds doesn't. Just kidding. But the other funds, the other funds just copy while we have some active selection involved. So it's a combination of passive and active. We're in between. We're hybrid. So I think it combines the best of both worlds, actually.
Okay, great. And then I think obviously the index idea is still I mean, as clear as we've tried to make it. We're still getting a lot of questions as to differentiating it to other types of products, right? So we have one here. How is the Smart Index the same or different as an ETF, which for anyone who doesn't know, is an exchange traded fund, right? And then the other side of it is, how is it different from the Alpha Opportunity Fund, which is also an ATRAM product? Yeah, maybe you can touch on both.
So let me answer the first question first. So the difference between this PHSE, or the Smart Index Fund, and an ETF is a matter of instrument. For example, if you want to invest in this fund, you have to subscribe and redeem from your fund manager, right? An ETF, though, is you can trade it like a stock. So once you buy, for example, once you buy an ETF, you can let go of that ETF by selling it to the secondary market from PSE, right? Where in this fund, you have to go straight to the fund provider, which is ATRAM in this case, and say, oh, I'm going to redeem my money. So an ETF is a combination of a mutual fund or a UITF and a stock, in a way that you get the exposure, but you can also have more liquidity by investing, by having a secondary market that you can dispose or buy more of an ETF of, like a stock. So that's the main difference of UITF and an ETF. The main difference of this fund, the Smart Index Fund, and Alpha Opportunity Fund, it's very large, right? So there's a spectrum. There's a index trackers, the passive. Then there are active funds, and there are small cap active funds, right? And we are in between. So Alpha Op is an active fund, purely active fund, and they invest more in small and mid caps and growth strategy. So if you want that exposure, you can definitely get that exposure, because in this market environment, that also pays well. But obviously, that has a different implication to your portfolio than just investing in large cap and in a systematic way. Both are good. What I usually do in our portfolio in multi-asset is you want to combine both, right? Because it's always about diversification for us. If you want, for example, if you're new and you want that to investing, if you want that index exposure, say, put 90% of your money in this fund and 10% in Alpha. And as you get more comfortable with that kind of exposure, then you can increase your Alpha exposure. Similarly, for example, if you're a stock picker on your own, if you have a brokerage account, if you pick all those small caps, micro caps, and you think that you want to hedge a bit, you think that that is not a very sustainable way of investing, or you just want to hedge, then you can invest in this fund and then do still your own trading, right? Because those two are completely different ways on how to make money and how to invest for the long term. To summarize, PHSE is an active, and it's a hybrid of active and passive. It invests in the PSEI components, while the Alpha Opportunity Fund invests in small mid-cap companies that have growth characteristics. So usually they're not the same exposure. Usually we do not hold the same stocks. So if you want to have a good diversification within the Philippine equity market, you can hold both. And it depends on your risk appetite on how much you hold of each one.
Okay, great. Okay, continuing on with the product itself, are changes in the weightings within the fund completely rules-based, right, with our system in place and everything, or are there times where you step in and make the call?
Santi, I think I lost you there.
Hello? I'm coming in
Yeah,
clear?
I think I lost you again in that last question.
No problem.
I think my I think my internet doesn't want you asking questions anymore.
No worries. No worries. Yeah, I think there's so many good questions that are just coming in.
Can you repeat that? Yeah.
Yeah, no problem. So are changes in the weightings within the fund completely rules-based, or are there times where you step in and have to make a call?
That's a very good question. So in general, in normal market circumstances, we do not we have no discretion over what we do in the fund. Like there's no like, oh, I want to invest in, let's say, more SM or more AC versus what the method implies. There's none of that. We have what we have though are different rules for taking different actions. So for example, in normal market environment like now, we don't think there's going to be a black swan again so far. So what we do is we look at the signals that they give us, that methodology gives us, and then we apply that. There are quarterly rebalancing that's happening for this fund so that we can use the most recent information available, because information is gold for this methodology, and we have weekly information. The second thing to be aware of is that even we are not an index tracker, right? So we have some discretion. Like for example, back in 2022, when we knew that as a global multi-asset portfolio manager, we knew that this COVID thing is pretty bad for risk assets, right? We saw that in China already. We saw that in Hong Kong, in Taiwan already. So we thought that it's gonna be broad-based equity sell-off. So the question now then became, we are a hybrid tracker. We do not have we don't have cash in general because we are fully invested most of the time. But in this case, there is a systematic risk to the system. We're higher than 50% probability that the equity markets will be impacted by this COVID. And hence because of those rules that have been met, that we increase the cash levels of the fund. And that's also one of the reasons why we outperform. So we outperformed last year in two ways. So one is that the signals pointed us to invest more in defensive sectors like telcos, and one of the biggest beneficiary was like Telephone and Globe, right? And utilities like Meralco and Pure Gold, for example. We were overweight those stocks because of the signals heading into this COVID recession. We also underweighted property and banks, and that did well for us. But at the same time, because of that method of reducing cash when there is a systematic risk and the rules have been met, then we reduced also our exposure a bit. So that in case, like for example, when it went to 4,100 intraday, we have some bullets, we have some dry powder to deploy and make money for our clients. Because like what I said, we're not just copiers, we're active managers, and we combine the best of both worlds. And I think it's not prudent for an active manager and any fiduciary in general to not save money when you can. So that's what we did.
All right, and just not too long here. As a hybrid tracker, what is the historical tracking error so far of the product versus the PSEI?
The historical tracking error, we have a limit of 2 in normal times, but in general, what happens is that it can go up sometimes when, for example, back in 2020, you have a bit of cash, so that increases your tracking error. I think for those who are not familiar with the tracking error concept, it just explains how the fund performance deviates from the benchmark, like the PSEI. So for example, a simplified example is that if, for example, the PSEI is up 1%, and then what is the return of the fund? Is it 1% or 1.1% or 0.9%? And that deviation from the PSEI return, that 1%, is your tracking error in general. And you look at that every day and every week. So that's tracking error for those who are not familiar. But yeah, our limit, our maximum limit right now, without a normal times maximum is 2%. We try to be in between all the time. Obviously, in between rebalancing, it can go up or it can go down because market changes, weights change. So it increases the deviation from time to time. But we have a rule. It's also a rule that we don't go above because we are still hybrid.
All right, and for my last question, you can answer this any way you want. All right. What is the disadvantage of the fund, if there is any?
The disadvantage of the fund, I would say, is that it depends on the perspective, right? But if it also depends on the context. Like what I mentioned, this is a PSEI. We invested the PSEI components. So for example, let's say the PSEI is at 9,100. It's 25 times PE. What's the likelihood that it can go to like 15,000 or like 13,000 in the next 1 month or 6 months? So that means that it's kind of overvalued, right? We're index trackers, hybrid. That means that we invest in higher valued companies now. That if and when there is a market correction, we will get the brunt of it. This is, as I mentioned, contextual because if you're an active manager, a purely active manager, what you can opt to do is just hold cash or just don't invest if there is no opportunity, right? But as I mentioned, also, if you look at the performances of active managers, it's not, especially the median active manager, you take a lot of risk, you have a lot of return. So there's a lot more opportunity and risk there. So it's sort of like that. We are not aggressive, definitely relative to other active managers, and we are not passive as like index trackers. So that's like what the philosophers say, your strength is your weakness also, right? And it depends on the context. Obviously, in this kind of environment, we're doing well. We have rules to take advantage of opportunities, but we limit our aggressiveness because we know that there's an opportunity here, and this is what the clients are paying us for. This is the fund. This is a systematic fund. That's a smart index. They know what they're getting into. They allocated the fund. So we're gonna give them what they are paying for and what they bought. Because we don't want naman, for example, I bought a smart index fund and this cash is like 20%, right? So basically you did not buy a smart index anymore. That's an active fund, and that has different consequences for your portfolio. So there. So in summary, our strength is also our weakness, but obviously if you see our past history and fund performance, we definitely we have more strength than weakness, and it works well for us.
That's what they want to hear, I'm sure.
Yeah.
Okay, well, thank you to our audience for all your questions. Please stay tuned to find out if you're a winner in today's raffle. Before we wrap up, any last words, Ivan?
No, so I'm really excited to be able to share this smart index fund. It started as an experiment back in 2016, right? And then we improved on it bit by bit as we go along, because we learn a lot of things. And as you all know, the market is not static. There's a lot more information. Our weights are not really that static. If, for example, our methodology starts to slip, or for example, does not give us the outperformance that we want, then we are always open to changing our methodology to keep that outperformance and reduce our risk for that. So, like what I said, it's a rules-based approach. We have our rules, we have our weights, but we are also on the lookout if those rules start to not work for us. So you have to know when it doesn't work and when the market or the environment shifts. So that's why I think it's very important to have an active manager to do that for you.
Okay, excellent. Thanks, Ivan. I'm sure you guys are interested to know about how and where to invest in ATRAM funds, including this ATRAM Philippine Smart Equity Index Fund. May we call on Nika Lim to tell us more?
Good morning, everyone. To open an account with ATRAM, just visit our website at atram.com.ph. Here, you can learn more about all the funds we offer. It will then guide you to our online investment platform, Seedbox, where you can start investing in the ATRAM Philippine Equity Smart Index Fund for just 1,000 pesos. But if you have more questions, visit the website's frequently asked questions page or ATRAM Academy page as well. And we are pleased to inform everyone that you can soon invest in the ATRAM Philippine Equity Smart Index Fund via GCash Invest. Please stay tuned for further announcements. Thank you.
All right, thank you, Nika. As promised, here are the winners of our ATRAM merchandise. Thank you all for your questions. We will contact you through the details you provided in registration on how to receive your prize. Thank you to Ivan, and of course, a big thank you to our audience. We appreciate you for once again taking the time out of your day to join us. If you have any further questions or would like to learn more about ATRAM, please visit our website at www.atram.com.ph. In case you have not registered for our webinar next week, which will focus on the brand new ATRAM Philippine Sustainable Development and Growth Fund, you may do so by scanning the QR code flashed on the screen. We also have webinars lined up for the rest of the month. Please make sure to tune in to them as well. Once again, if you have any friends who you think would like this webinar are unable to attend, please feel free to share the YouTube replay of the session. To do this, visit our YouTube channel, ATRAM Studios. Lastly, please answer the survey at the end of the webinar. We would love to know your thoughts on this topic. On behalf of everyone at ATRAM, thank you very much. Have a great day and a long weekend.